So, you found a company you think could be a great investment. Maybe you love their products, or you've heard good things, or you saw their stock prices going up. That initial spark of interest is a great starting point, but it's not a strategy. Buying a stock based on a feeling or a hot tip is like getting married on a first date. It has a huge commitment with very little information. The single most important skill you can develop as an investor is knowing how to properly research a company before you ever hit the buy button. This process is called due diligence. And it's what separates the gamblers from the genuine investors. In this guide, we're going to walk through a complete, step-by-step framework for vetting a company. We'll look at the big picture story, dive deep into the financials, and uncover the red flags that most beginners miss. By the end of this, you'll have a clear checklist to follow for any stock you're considering, transforming you from a hopeful speculator into a confident analyst. Let's start with the big picture, because even the most profitable company is a bad investment if it's in a dying industry. First, you need to understand the company's business model. In simple terms, how does this company actually make money? This seems obvious, but you'd be surprised how many investors buy shares without a clear answer. Is it selling software subscriptions? Manufacturing physical goods? Providing a service? You need to be able to explain it in 1 or 2 sentences. Next, assess the industry itself. Is it growing, stable, or in decline? A great company in a shrinking industry has to work incredibly hard just to stay in place, while an average company in a booming industry can be carried upward by the tide. Finally, and this is critical, identify the company's competitive advantage, also known as its economic moat. What does this company do that prevents competitors from stealing its customers and profits? Is it a powerful brand name that commands loyalty, like Coca-Cola? Does it have a technological patent that can't be easily replicated? Is it the low-cost producer in its industry, like Walmart? A wide and durable moat is what protects a company's profits over the long term. Once you understand the story, it's time to verify it with hard data by looking at the company's financial statements. This is where many people get intimidated, but we're going to focus on just 3 key documents and a handful of vital metrics. The 3 statements are the income statement, the balance sheet, and the cash flow statement. You can find all of them in the company's annual 10K or quarterly 10Q report, which are filed for free on the SEC/SEDGAR database. The income statement shows you a company's profitability over a period of time. Here, you want to look for consistent growth in revenue and, even more importantly, net income. Is the company actually making a profit, and is that profit growing? The balance sheet is a snapshot of the company's financial health at a specific moment. Here, you need to check the company's debt levels. Compare the total debt to the company's equity. A high debt-to-equity ratio can be a major risk, especially if interest rates rise. The most important statement, according to many legendary investors, is the cash flow statement. Specifically, look at operating cash flow. This tells you the cash generated from the actual business operations. A company can manipulate earnings, but it's much harder to fake cold hard cash. A healthy company consistently generates strong positive cash flow from its operations. Now, let us use those financial statements to calculate some key ratios that will help us determine if the stock is fairly priced. The most common valuation metric is the P/E ratio, or price-to-earnings ratio. It's simply the current stock price divided by the company's earnings per share. A high P/E ratio could mean the stock is overvalued, or it could mean investors are expecting very high growth in the future. Don't look at it in isolation. Always compare a company's P/E ratio to the P/E ratios of its direct competitors and its own historical average. Another crucial ratio is the return on equity, or ROE. This measures how efficiently a company is using its investors' money to generate profits. A consistently high ROE, say above 15%, is often a sign of a great business with a strong competitive advantage. For the final step of your financial deep dive, you must read the company's annual report, specifically the management discussion and analysis section, and the risk factors. This is where the management team explains their view of the business and the challenges they face. Are they confident and transparent, or are they full of excuses? The risk factors section will openly list every potential threat to the business, from new regulations to supply chain issues. It's a required reading that most investors skip, giving you a significant edge. Your research isn't complete until you look at the people steering the ship. The management team is responsible for allocating capital, and their decisions will ultimately determine your return. Do a quick search on the CEO and key executives. Look for a track record of success and integrity. How are they compensated? Look at the proxy statement to see their salary and bonus structure. You want to see that their incentives are aligned with long-term shareholder value, not just short-term stock price pops. Do they own a significant amount of company stock themselves? Skin in the game is a powerful motivator. A CEO who owns a lot of shares is more likely to act like an owner. Finally, step back and synthesize all this information. Does the story from your big picture research match the reality of the financial numbers? Does the current stock price make sense given the company's growth prospects and profitability? This entire process is not about finding a perfect company. It's about identifying a good company that you understand, with a durable competitive advantage, trading at a reasonable price. It's about making an informed decision with confidence, knowing you've done your homework. Remember, this is educational content and not financial advice. Investing always carries risk, including the total loss of capital. You should always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions. If this deep dive was helpful, please show your support by liking this video and subscribing for more analytical breakdowns. Now, I want to hear from you. What's the first company you're going to research using this framework? Let me know in the comments below.